This is a tale of two stocks. One is my best investment to date and the other potentially my worst. One has generated me 420% returns all time and the other has lost 93% of its market value. Both compete in the world of AI and both I have held since 2022. One of them is one of the most world-renowned companies out there and the other is a struggling startup with its back against the wall. Despite this, I think that this struggling, fledgling company still has the potential to even surpass this business that I am talking about today. So who are we talking about? Well, one is Meta Platforms and the other is Versus AI. In this video, I'm going to provide a holistic analysis on both of these companies, how I came across them, the story behind investing, a current analysis of the business, and then ultimately make my case as to why you should still seriously consider Versus despite all the turmoil. This is definitely going to be an episode you want to pay attention to as it showcases what it takes to try and make sense of this whole AI dilemma without being an expert and what you must understand in the current dynamics of this industry today. Now, as always, if you find the content interesting, make sure to give a like and follow and be sure to comment to help support the channel. With that, it's time to dive in first into Meta AI. Meta is a well-known company for many reasons. I think a lot of people started to really understand it once Facebook burst on the scene. Everyone was building accounts and the story behind the company was supported by the movie The Social Network. And even though Zuckerberg has openly claimed that the video itself doesn't accurately portray the story behind it, I think more than anything, it allowed people to understand what it took to build this company and set the framework for what is now a $1.5 trillion business that is dominating the social media space, communications, entertainment. They're breaking into hardware, and now their next push is super intelligence. It is truly one of the most exceptional companies out there. Their growth rates, their fundamentals have been just on an absolute tear over the past decade and a half, and it looks like there's no end in sight. With that, the company did recently just provide its financial data for the recent year, so we'll dive into that. But I also want to explain kind of the context behind when I made my investment, why I continue to hold it, and where I see the business going. So first things first, I invested in Meta Platforms back in 2022 when the stock just absolutely plummeted. And you can see here that there was a time where the business was growing quite steadily, but as the AI bubble progressed, or I shouldn't say AI bubble, but the COVID bubble progressed, the company reached a $1 trillion market cap. And then it just looked like all hell broke loose. And really the background behind this is that at the time, one, Meta was investing heavily in its reality lab segment. They were making a huge push into virtual reality and it wasn't realizing any returns from it. It just continued to burn cash and they were investing tens of billions of dollars every year. And they even continued to do that well beyond this period here. But especially at this time, with prices of stocks inflated, investors started to get spooked and the market started to sell. Now, in a similar instance, TikTok was also making a huge push. This is post-COVID or post-pandemic times, but that's really when TikTok bursted on the scene and it was becoming a real threat for Meta's social media business. So two kind of factors that really caused a lot of fear in the market. The stock initially fell about 10% roughly. It started to pique my curiosity, looked interesting, and it didn't take long for it to fall nearly almost 50% in a very, very short period of time. From August of 2021 to just February 2022, it essentially went from a $1 trillion market cap to a $500 billion market cap. At this time, it started to fall in my price rate. It looked still attractive. Why? Because the business was producing billions of dollars of free cash flow, double-digit free cash flow. Same thing with profit. And its revenue was growing significantly. The business also had very, very little debt. So from a fundamental standpoint, all indications pointed that the company was still fundamentally strong. And even though it was burning cash in Reality Labs, that surely wasn't their main business. They continued to operate Facebook and Instagram, as well as WhatsApp, all platforms with billions of users at this point. And it wasn't like people were going to stop using Instagram or Facebook or even WhatsApp, even though they haven't monetized WhatsApp. But the main core business was still continuing to operate as normal. And what it seemed like is that the market and investors and Wall Street kind of put way too much emphasis on this push towards virtual reality without factoring in how productive their other businesses truly were. So at this time, I started to buy, and I think the business was trading at about $300 per share, roughly. And, things looked pretty solid. Interesting enough, though, is that even as I started to buy around this time, well, the stock fell virtually another 50%. It fell from a $500 billion market cap all the way down to at one point being just worth $241 billion. A huge, huge drop. And from peak to trough altogether, it fell 75%. Now, what did I do? Well, even though I bought at this midpoint, I didn't know where the stock price was going. I surely thought that it was undervalued now at this point, but it could have easily turned up and returned, and I generated a nice return immediately, but the stock kept falling. People's fear was being perpetuated, and it wasn't just Meta. Meta wasn't isolated. There was a lot of stocks at this time affected by broader market fear and led to a further crash. But rather than panicking and saying, hold on a second, maybe my analysis is wrong. What if I've really messed up? Oh no, I've lost 50% of my value already in this business in a really short time. Well, I just kept buying. And I bought more shares at cheaper and cheaper prices because I continued to believe that the business was undervalued. It looked really attractive and its fundamentals were strong. So it gave me a certain degree of confidence that I thought, hey, even though things don't look too great right now from a share price standpoint, everything else is indicating that the business is still really solid. And now the market has really mispriced the value of its assets, the company at large, and what it is capable of producing. So kept buying, lowering my average, and I ultimately got down to an average price point of about $90 per share, roughly. So from this point, who knows? Maybe the company and the stock would continue to sit flat and struggle, but that certainly hasn't been the case. And as you say, since about November 2022, things have just exploded. Meta's gone on an absolute tear. A lot of this is primarily, again, just due to their main business, nothing in particular. But then, as you've seen in more recent periods, especially with the AI hype in the past couple of years, it has continued to push past. And, at one point, it almost hit a $2 trillion market cap. Now it's settled about $1.6 trillion. So it's been a phenomenal return. Like I said, I generated about 420% all time since 2022. I did sell a portion of my shares at about $500 per share, which looking right now kind of seems like I regret it. It would have been greater. And I've always preached that you want to hold assets for the long run, even if they do kind of expand past their fundamental worth or intrinsic value. But I think it was a good lesson early on. I started investing back in 2022. So still a long way to go, still a lot of lessons to learn. But I think that was a good one in just understanding that when you find a really like a diamond in the rough and you find something that is going to continue producing, oftentimes it's better to just continue holding, even if in the short run it may look a little overvalued. And you don't necessarily have to purchase shares at that time, but you continue to hold. And if the stock corrects, prices get more attractive, you go buy more. That's kind of what I'm hoping with Meta right now, as I kind of mentioned in my previous video, but something to pay attention to. So now that you know the background behind my investment, well, let's look at the recent developments. Let's look at the company's latest news in terms of productivity overall. So Meta released their 10K for 2025, and you can see now the annual financial data on a full year basis compared to 2024. And things are looking pretty solid, especially for a company of its size. In revenue, they generated $201 billion of revenue in 2025 versus just $165 billion the previous year. So 22% growth year over year. Their costs, this is something that you'll notice is a theme with this business right now, is their operating expenses in 2025 was $118 billion versus $95 billion, a 24% growth. So just as their revenue is expanding, so is their operating expenses, and they're actually slightly outpacing revenue right now. And this is going to be supportive of their huge infrastructure push to develop superintelligence. As you can see here, CEO Mark Zuckerberg has laid out that the company's present objective is advancing personal superintelligence for people around the world. Zuck has laid out the game plan. This is what all their investments are supporting and revealing at this time. You know, they recently announced a partnership with Blue Owl Venture, a $27 billion investment into AI data centers. They also just talked about signing a new long-term multi-billion-dollar lease with Google for their TPU processing chips. And so everything is aligning to that push. You're seeing that in its operating expenses. You will also see that in their CapEx shortly, but that's a big theme for 2026 and definitely the near term. For the next couple of years is Meta is investing heavily in their AI infrastructure. They want to win this super intelligence race, and they are going to take the chances to do so. Now, actually on that point, because I think it is important, and one of the reasons I am so attracted to Meta versus many of the other AI companies is Zuckerberg and team are willing to make aggressive bets. They have high conviction in their investments, and they are willing to fully support them in order to make them come to fruition. Now, not every asset, not every investment has panned out the way they have hoped, but when a company reaches this size and scale, and for a platform business like Meta, there comes a time when your products, your existing flagship products, tend to mature, and you can either reap the benefits of being a cash cow, or you can continue to try and innovate, survive, and reach that next frontier. And that's what Meta has continually done. And so I praise them. Even when it came to Reality Labs, and you know, they're still going to make some investments in Reality Labs, but they're definitely scaling it back. They have always said that this is what we believe in. This is what we are going to try and grow, and we are going to try and be the best at it. And I commend them for that. Not every business out there is like that, especially at its size and scale. But when you compete in such highly competitive markets like they do, you got to make those pushes. Now, next element of it, you can see that from an operating margin standpoint, 41% in 2025, 2024, 42%. So relatively the same. And this is in 2 years where their operating expenses have significantly increased. So solid operating margin overall. And then from a net income standpoint, well, you're seeing $60 billion of profit that they're generating versus $62 billion in the previous year, minus 3%. So they've actually dropped a little bit, which isn't necessarily ideal for sure. But I mean, $60 billion of profit, where that's just cold hard cash coming into the company, that's pretty damn good. And you're seeing that reflected as well in their diluted earnings per share, where right now it's at $23.49. Which is phenomenal overall. And even though you're seeing a slight decrease, push comes to shove, the business is still highly productive. Now, one thing you would want to note and pay attention to is how this trends over the next coming years. Do they continue to contract the amount of profit that they're making? If yes, then maybe their AI bets are becoming too aggressive, and maybe they haven't necessarily thought it all through, or perhaps their products are not demonstrating what they believe in. They're not producing the type of returns that they were initially hoping for. So something to keep in mind. But at the end of the day, what you're seeing here is that they're family daily active people. So this is across their several platforms, whether it is Facebook, Instagram, WhatsApp, Facebook Marketplace, you name it, all those platforms, they currently have on a daily basis 3.6 billion people using their platforms. 3.6 billion people. That is nearly half the population of the world right there using their platforms. There are so few companies out there that even come close to that level of productivity, and Meta is at the forefront of them all. Really, the only other business that really hails in comparison from a platform standpoint is Google. And so when you're in that upper echelon of companies out there, you know, there is such a powerful network effect, and that is really what comes down to Meta's greatest moat, is the network effect they've created, where there are content creators attracting users who then attract businesses who want to advertise on the platforms, and it creates this cycle, self-sustaining cycle that continues to compound on itself, and that's what you're seeing here. And in December 2025, there was a 7% increase. So people aren't going, they're not switching platforms. And even though people may use TikTok and X and other different platforms, they still continue to rely and depend on Meta's platforms equally, if not more. And that is being demonstrated this is truly one of the most powerful businesses across these platforms that they have. And it has built this self-sustaining environment that is truly one of a kind, and is why I'm so attracted to the company. But on top of that, well, you can see that part of their investment into AI is helping improve ad impressions and average price per ad. So in terms of impressions, well, it increased 18% in the fourth quarter year over year and 12% versus the previous year. So that is a direct reflection of the value of their investments, increasing the quality of the ads, their reach to consumers, and being able to convert ultimately into paying customers, something that is very favorable. That's what you want to see from a business like this, is that they're improving the quality of their services. Same thing with average price per ad. It increased 6% versus 9%. So not only that, but their margins for each ad are increasing healthily, and something that you want to look at favorably overall. Now, next part, as I talked about revenue, well, this is a general reflection of all the dollars that they're converting for the products and services that they provide. And in the recent year, as I mentioned, they created $201 billion in 2025, which is a 22% jump from the previous year. Same number as is. And in terms of the growth too at that size, that's just further supporting how impressive this business is overall. Now, the one thing that I did highlight earlier is operating costs have jumped quite handily, 24% year over year. This has jumped to $118 billion, which is a massive spend. But again, when you're generating $201 billion, you still have a healthy gross margin. This is an operating margin. This is going to translate down. And as I highlighted earlier, they still had net profits of $60 billion. So they're still pulling a lot of money in. And even despite these higher operating costs, in order to sustain the infrastructure, the energy consumption, as well as the human capital to develop these assets, they're still in an overall healthy position. Now, on a longer term element, which is capital expenditures here, you're also seeing a massive jump where in the full year, they invested $72 billion in capital expenditures. So this is long-term projects. This relates to the data center and the building of the data centers, the creation of the infrastructure that goes behind its intelligence. Zuck has clearly outlined that they're going to invest heavily, and I believe in this upcoming year, they're even making a push to go increase CapEx to about $115 billion to even $130 billion of CapEx spend. So these are massive long-term investments that they are paying and willing to take a bet on. And ideally, as an investor, you hope to see that pay off. Now, from this, you can see we can talk about capital return. They've bought back stocks and paid out dividends. They have $82 billion of cash on hand. So their cash pile is very, very healthy, even with a changing environment. And if things don't pay out, they're sitting on $82 billion of cash that they can deploy at any time with very minimal risk. You're seeing solid cash flow, operating cash flow, and free cash flow returns. So this is factoring operating cash flow minus those CapEx spend here. You're getting free cash flow of $44 billion. Still very, very healthy overall, even with these heavy long-term investments. And then the last element here is, well, they've brought on $59 billion of long-term debt. And once again, they have cash on hand, but if you can get debt at a reasonable rate, well, they're using this debt to support their investments into AI as well. So a lot of things pointing, at least in this new year, just highlighting that they are making that push. They're still a very, very healthy business. They have a lot of productivity there. As the CFO outlines here, total expected expenses are to be in the range of $162 to $169 billion, an insane number, but it's a productive company overall and favorable from that standpoint. That said, we are talking about AI and Meta's present standing relative to its peers. You want to assess how the quality of its assets are performing. And right now, Meta is operating with its Llama 4 infrastructure, so the fourth iteration to some extent of its large language models, and they're certainly impressive. It's one of the largest open source platforms, which is rare compared to a lot of these privatized, isolated models. But from a standpoint of comparing quality, well, I think it's important to highlight where do its models stand. Well, you can see that Gemini right now is leading the push in terms of the Artificial Analysis Intelligence Index. GPT, so ChatGPT's completing their Claude's up here, a lot of good stuff. And you even start to see Alibaba making a push, DeepSeek's in here. But the one thing I wanted to highlight is based on at least this benchmark and the comparative standpoint, is it takes quite some time until to come across an actual meta model. And in this case, it's the Llama 4 Maverick. So what does this mean? Well, I think it speaks to the general risks that exist in generative AI, large language models, and the machine learning market or industry as a whole is one, as you can see, there are hundreds of models today, and the leaderboard, the highest quality products are constantly changing. There are businesses and from all angles right now investing, trying to produce the most productive model. And the good news for consumers is that you continually have a lot of optionality and you're getting better and better products. From an investor standpoint, however, you're running into a situation where this industry is becoming highly commoditized. Investors or consumers have their pick of the litter. They can choose the most low cost effective model out there, and they don't necessarily have to stick or stay with any asset or model because there's just so many choices. And for a company like Meta right now, what you're seeing is that there is some risk where their assets or their large language models are not necessarily the most high quality out there in the market today. And so do they want to make a push and try and make these models the best in the world? Well, that's definitely what they should strive for. But I imagine also there's a lot of internal direction where they're trying to focus on enhancing their own products today. And it is something to consider, at least from a quality standpoint, that there is a level of risk that they're investing so heavily, but there is a lot of options out there. And based on this benchmark, at least, there's a lot of better models out there at this time. Now, I did see that while, again, one of the biggest pros and arguments for Meta's large language models is that they are open source. Even at launch, they are usually able to catch up to the frontier models about 13 weeks after launch, and that's based on an MIT study. So they ultimately catch up, but really what you're seeing in this market today is that all these companies are competing to try and produce better and better models, ultimately achieve super intelligence, because once you can reach that level of productivity, and to be clear, we are not even close to super intelligence, let alone general intelligence. So we are still in the early stages of this thing. But the idea is that once you can reach that point, well, the thing's going to just continue to operate autonomously, and you're going to reach a level of productivity that is just going to compound, where you kind of take the hand off the wheel and you're just generating boatloads of cash. So something to consider anyways. Now, it's quite impressive, but we can look at then from a long-term standpoint, how Meta's growth has produced, where it is today in terms of intrinsic value, and then we can discuss kind of my current thoughts on whether it's worth investing in at this time. So as I've highlighted here, you can see that from a revenue standpoint, they generated $201 billion, net profit, $60 billion. They have $217 billion in book value, $59 billion of long-term debt. And notice this jump from $29 billion in 2024 to $59 billion. Operating cash, pretty solid jump as well. Right now at $116 billion. CapEx at $70 billion in the past year. This is a jump from $37 billion. Once again, reinforcing just how much they are pushing to invest in this infrastructure right now. And they also have $82 billion of cash on hand. So really, really strong fundamentals. You can look from a long-term growth standpoint. Revenue's growing at 25%, net profit at 22%, book value at 16%, and free cash flow at 17%. And on a weighted basis, their growth rate right now stands at about 18% for the next 5 years anyways, is what I'm anticipating, and then 9% into perpetuity. Solid numbers overall. This is producing excellent free cash flow, and you can see based on my analysis and my projections that in 2026 they'll generate about $57 billion in free cash flow, which is solid, and then $66 billion, and then it's just going to jump, and by 2030 anticipating about $108 billion in free cash flow. You discount that back at 15% to present value, all those 5 years, including all remaining existing years of the business, gets you the net present value. From there, we subtract long-term debt and add back cash. And you can see that I believe the intrinsic value of Meta today is $1.1 trillion. Solid, massive business. The only thing right now is that the company is currently trading at a $1.6 trillion market cap. So there is some room right now where it is trading at about a $500 billion premium. It is a fantastic business. I really enjoy Meta in many aspects, and I've benefited greatly from being an investor. I continue to track it closely. I think it is going to continue being an excellent business for many years to come. As I mentioned, I'm a big fan of their ability to take large bets and try to make the reality that they believe in, and Zuck has done that continually. On top of that, he owns, I think it's like roughly 30% of the business and the company's publicly traded shares. It might even be more than that, but it is so rare to see a company or a CEO own so much of the business. And he is one of the very few who continues to keep his conviction entirely in his business. This is his baby. He built it from the ground up. He wants to make it his reality, his legacy when it's all said and done. And I have a high degree of confidence that when he is making investment decisions for the business, he is doing it with heavy scrutiny, a lot of discipline, and trying to make the best decisions for the long run. And you're going to continue to see that. So big fan of Meta overall. And while I am not purchasing shares at this time, just because of the relationship between its intrinsic value and the company's current market cap, I'm following closely. And if the stock corrects, which I do believe is potential given all the AI hype that has surrounded it and other businesses, that there may be an attractive investment opportunity in the future to buy more shares of Meta. And this time around, you can be sure that I will not be making the same mistake. If I can buy this thing at 50% below its intrinsic value, I will be holding these things for the next 20 years and beyond. Make no doubt about it. Now, with that, we have covered the first of our companies, certainly one of the best businesses out there and one of the most interesting companies in the world. And now it's time to talk about potentially my worst investment decision to date. So, Versus AI. How did I come across this business? Well, I was working for a financial media company just coming out of university, and it was a great experience overall. Gave me an opportunity to be introduced to this company at a very, very early stage, and I liked what I heard. You know, I was exposed to a lot of early startup businesses, and none of them really stood out to me aside from Versus. It was the only company that I ended up actually investing in, and all the others, you know, it just, the fundamentals didn't seem to reflect something that had great potential long-term per se, but Versus stood out to me. And the reason why is because while all these massive tech companies out there are producing large language models, they're using a machine learning framework to develop their systems. They're building transformer architecture in order to create these AI models that we interact with every day now. Versus was taking an entirely different approach. And this all stems from something known as active inference, which comes from Professor Carl Friston. So if you do not know who Carl Friston is, he is a neuroscientist from London who, while working in the same college as Geoffrey Hinton, saw a completely different way in order to try and make sense of intelligence and tried to base it on the biological nature of existing entities. So whether that's a human, any type of animal out there, plant, it tried to make sense and create an approach to intelligence that was reflective of nature, which is in contrast in many ways to the machine learning approach that we see today. And let me preface this, that I am not an AI expert, but if you are like me, an investor who wants to try and capitalize on these products and this technology, then you need to do your best job of trying to make sense of it. And that is what I have essentially done. So I invested in Versus in 2022. I have not sold a share since. And like I said, the stock is down, or my shares at least are down 93%, which is a huge wallop. And many of you are probably going to look at this and be like, this guy's crazy. Why the heck would you continue holding? You know, why would I ever listen to him? All rationality went out the door. And in some sense, it's kind of true, because I have preached in every video so far in everything that I've shared that you want to stick to high quality businesses with really strong fundamentals, and then you want to be able to value them. Well, as I said, Versus is a startup. The company does not have very strong fundamentals. You'll see that the financials are kind of shaky, and it is difficult to value them because it is so new. But what it comes down to is the core principles of the technology and how it deviates from the large language models that are being built by everybody else. I'm telling you, there is no company out there, or there are so very few that are taking a different active approach to developing this system, that it is beyond me how people have failed to recognize that there are different approaches out there that may be way more efficient than those that are out there today. So what is active inference? Well, when it comes to AI models today, they are built in a way where you collect a massive amount of data, and then you try to organize it in a way that you're creating the relationships between all these millions and millions of points of data. And there's a statistical relevance that either the data or computer scientists teach the model essentially, or to some extent it learns on its own through reinforcement learning. So you give it all this data, then you try to create these comparisons and likeness between different information. And ultimately what you're trying to get is a point where when somebody enters in a prompt, you put in inputs and you list out, you explain a certain sentence. Well, the system itself goes through millions and millions of calculations and tries, based on this information and based on the prompts that I've been given, that this is statistically the most reasonable response or output based on the information I've been given. And this has worked very well in many instances. As you're saying with generative AI, you're able to streamline a lot of processes, whether it comes to coding or producing images or writing things, all ways in which using these massive data piles has enabled people to come up with some pretty impressive and creative things. The limitations with these systems is that it is largely dependent on historical data, really ultimately all dependent on historical data. It requires a massive amount of this data, and on top of that, it requires a huge amount of energy in order to actually produce computations from it. And so, over the past, well, really since the emergence of AI, and this goes all the way back even to the 60s, is machine learning has been the primary framework or approach that has dictated all development of AI technology today. It uses this fundamental approach of massive data sets. You train the data, you teach it by giving it reward functions that, yes, you are coming closer to creating that likeness and finding the right answer, and then getting it to a point where it can kind of self-improve on its own to some extent. Now, the problem with it is that each time you develop a new model, you have to gather this data again, retrain it, and then build the infrastructure to support these calculations. And that costs a lot of money. It's also stagnant in the sense that the systems itself really struggle to adapt. And so I think a good example of that is autonomous vehicles today. I saw a video not long ago of a Waymo vehicle during driving and stopping right in the middle of a police standoff, where a potential criminal, and I'm not exactly sure if they ended up getting convicted, but they're on the ground with their hands behind their head, laying on the ground. There are police cars lined up across the board, and the Waymo just drives in right next to this person on the ground and is parked right there. And why is it? Well, because again, it's trained on all this historical data. It's given all these examples of the past of driving in different environments, and it uses that as its baseline guidance for how to operate in the world. But the moment it experiences something random or new, the system essentially ignores all context. It doesn't realize this is something different, and it continues to operate in the same way. And this has a lot of risks, especially for enterprises where you are trying to create a business that is capable of adapting and evolving and making real-time decisions just as its employees do on a regular basis. And AI just hasn't necessarily been able to do that. So flipping it on its head, active inference essentially operates in a way where it requires very little base foundational data, and it is able to essentially actively make predictions based on the information in the world model it is creating, and then adapt and receive feedback based on the predictions it makes, and then continually create this feedback loop where it is going between acting and applying its predictions, receiving feedback based on those predictions, and then adjusting its understanding based on that. So it kind of flips it on its head, where rather than starting from a place where you know everything, like large language models from the start, but then you don't know what you don't know, it instead starts from a place of, I know very little, and I need to make sense of this environment, this world, by actually going out and testing it to actually gain information and grow my knowledge base over time. So what are the benefits of this? Well, it makes it very, as I said, much more adaptable compared to large language models. It's also more efficient because you don't have to go through millions and millions of calculations. You just use very little data to start, and you basically just create these beliefs and go and try and apply them. And the last part of it is because based on this framework, you require a lot less energy to get to that point overall. So kind of highlighted the basics of active inference, where it started. This is the framework that Versus has taken approach. It's all based on Professor Carl Friston's work, and he's coordinated with a lot of researchers, both internally within Versus, but as well as his time as a professor. And they have ultimately reached a point where they've produced a product that now exists and is known as Genius. So what essentially does Genius offer? Well, first, it can sense things. So it perceives the world like we do, integrating sensory information that gives computers the ability to truly see, process, and understand. So this goes on to what I was saying, where essentially the argument is that it is much more context aware. It knows what it doesn't know, and ultimately it is trying to reduce the uncertainty within its world model. It wants to get as close to certain about everything as it possibly can. And when it comes to models, that reflects anything that really is a system. So that can be the world, can be considered a model as a whole, an ecosystem. Your household is like that. Financial markets are like that. There are systems all around you, and you can build these models where there's enough predictability to make sense of it, and it's not completely random. So you can kind of shape your framework and say that, okay, well, I've tried this thing. I've realized that this is the consequence or response that I've acquired because of trying this. And now I know that if I do the same thing again in the future, it is quite likely that I'm going to receive the same consequence. And that's how you start building a model. That's how you start building a framework around things. And then as you come across new things that are uncertain, unpredictable events or randomness, well, then you have to adapt and say, okay, well, maybe all my prior assumptions about this thing, maybe not every one of them is true. And I should understand that I need to, once again, try and make sense of this new information and reduce the uncertainty so that my world model is operating in a stable and comprehensive state where I have as much control as possible. So that's that sense element. The thinking side of it, again, serves as a digital brain with modules for memory, prediction, and reasoning that work together. So again, the system itself, Genius, has an internal understanding of what it knows and doesn't know. From there, you have to try and say, okay, well, based on what I know, how do I get to the most likely conclusion so that I have resolved this uncertainty again? So it's working through that. It's going through possible scenarios and outcomes, and then creating a plan that ultimately is going to get to that point of understanding that enables it to make the best decisions and outcomes overall. From there, it can act. So as it highlights, there is examples of it allowing robots and agents to learn new tasks quickly in physical and digital worlds without extensive pre-training that conventional systems require. And then the last part of it, and this is based on the spatial web standards, which Versus also contributed to, is not only is this AI agent or system learning on its own, but it's able to distribute that knowledge and information to other agents and systems. So they don't necessarily have to start from ground one and have to try and make sense of everything from the get-go. It can be passed along. So it's a lot more open and collaborative compared to a lot of the isolated systems that operate today within large language models. They do not work in this environment. You can't go to ChatGPT and it's passing on information to Gemini and saying, hey, this is how I got better. This is what I found out. It does none of that. And that's why another reason why those systems are so stagnant. And on the other hand, Genius may offer a unique competitive advantage from that standpoint. Now, moving past the theoretical elements and kind of the base framework that differentiates Genius, here's how it's been put into practice over the past couple of years. First, mastering Atari games with natural intelligence. So what they did is there is a benchmark challenge for AI systems called the Atari 100K benchmark. What it essentially is an AI model is allowed 100,000 steps or attempts at a certain game in order to try and reach human level intelligence. And basically the benchmark measures how long it takes to reach that point of human level intelligence, and or does it supersede it, and how many steps it requires, how many parameters did it actually require in the first place to even get there to train it. So what Versus went out and did was attempt this challenge. They put Genius up against Iris large language model system. So this is based on the same transformer architecture that fuels systems like GPT, Claude, Gemini, Llama, all of them. And it competed head to head in a series of Atari challenges such as Pong, as you can see here. And for Genius, it had just 10,000 training steps. So the basic challenge is Atari 100K, as I said, 100,000 steps. Basically, Versus came out and said, well, we can do it way more faster and efficiently. We're going to only do it in 10,000 steps. That's all we need to reach human level intelligence. Well, they did that in just 2 hours of training time, and with just 350,000 model parameters, Genius was able to achieve not only just human level performance, but perfect play. Whereas relatively Iris in 2 days with 10,000 steps, barely even scratched the surface, is about 25% capable from a human performance standpoint. And the 2 hour one doesn't even scratch the surface, not even close to human level play in those 2 hours. So hyper efficient. You can see the level of productivity, and this translates to other games here as well that you can see. And then Freeway here, which is kind of like Frogger, you got to cross the roads. Genius in 2 hours was able to cross the freeway 17 times, while as neither of the Iris models was able to complete it once. So very, very impressive. As I highlighted, active inference here, very strong. But overall, it was able to essentially achieve human level play or better in just 2 hours of training and practice, using 90% less data than these other models, which is absolutely ridiculous. That was kind of their first showcase of what they were capable of. It was kind of a breakthrough moment and an exciting demonstration of how they could perform against top models, but the company wasn't done there. So the next one here, Versus AI put Genius against OpenAI's O1 preview model. And if you recall, just a year and a half ago, this was the highly touted Project Strawberry that essentially OpenAI was coming about. It was flirting that they were on the verge of artificial general intelligence. At the time, it was their premier model, and all things pointed to it being the best system out there. Well, as you can see here, Genius, compared to OpenAI's O1 preview model, solved 100% of the games 140 times faster and 5,260 times cheaper than OpenAI's model. So orders of magnitude better performance overall compared to the system. And you can see here that on a comp basis, that Genius had 100% success rate versus O1 preview 71%. Average compute time 3.1 seconds versus 345 seconds. Average guesses only 5.6 versus 6.1, and the total compute 5 minutes and 18 seconds versus O1 preview needed 12.5 hours. And then you can see the cost difference here, and then once again highlighted, it's about 5,260 times cheaper for total cost in 100 games compared to O1 preview's model, but it wasn't done there. From that point, there was a moment in time where DeepSeek's R1 model came out, and it basically put the world on notice. NVIDIA, I think, lost like $250 billion of market cap in a single day because this Chinese model came out and was able to do it at significantly less of a cost compared to OpenAI's premium model. But what people didn't realize, and what crazily didn't get as much attention, is Versus then challenged DeepSeek's R1 model and cooked it. So not only did it cook OpenAI's premier model, but it cooked DeepSeek's premier model, which Both at the time were hailed as two of the best systems out there in the world. And you can see that compared, once again, using the mastermind game, that Genius solved all 100 games, averaging 3.1 seconds per game at a nominal cost of 245 times faster and 779 times cheaper than DeepSeek. So once again, order of magnitude improvement relative to the large language models out there that were leading the game at the time. And, it just did not get the recognition that perhaps it deserved on a performance standpoint. Again, this is a novel approach. It is very different fundamentally from the large language machine learning approach that exists today. But I think people and the market at large wanted to see the commercial applications of it in order to give it full respect, because at the end of the day, these are being applied to various games, and AI developers around the world use these games and these benchmarks to test things, but it doesn't necessarily show if it's a feasible product. And I think that's one of the major challenges that you'll understand with Versus, is that for the longest time they were coming out with all this really impressive technology. It just wasn't necessarily translating over to from a commercial standpoint, and that kind of limited its exposure in the markets where people were talking about it. People didn't necessarily understand the difference between the two systems, and they said with examples like this, oh, this is cool, but how is it going to make me money? And that's kind of the next challenge. So in that time, after just demonstrating that they were able to significantly outperform many of the large language models and premium AI systems out there, they made the next push where they released Axiom, which is their digital brain. It has put a name to the active inference system and the infrastructure behind it that ultimately fuels its intelligence. And once again, now competing against one of Google DeepMind's top AI models in the Game World 10K benchmark, produced a normalized score of 0.48 compared to Axiom 0.77. So it had 60% better gameplay. Steps to competency: it took Dreamer v3 24,000 steps versus Axiom 3,000, so 7 times faster learning. GPU time to competence 6.23 hours versus just 0.16 hours, so 39 times greater computing efficiency. And then the model size: Dreamer 3 requires 420 million parameters, Axiom requires less than a million, so 440 times smaller. Once again, further demonstration, but now this is more up to date. This is the most recent highlighting of its capabilities relative to these large language model transformer architecture systems, and it blew it out of the water. Again, Google DeepMind, this is the company that came out with AlphaZero and AlphaGo and has revolutionized the world, put AI really on the map. Genius and Versus are kicking their butt. The problem is that, as you're seeing, is the stock has just completely plummeted. Came out and they've consolidated shares, but at a time it was worth $20.57. It reached a peak of nearly $60 per share and has since fallen down to just 75 cents per share. Ouch. That is a huge drop, and to be honest, I have held through all of it. There have been times where there was probably moments I probably should have sold, and in hindsight it certainly looks like that. But once again, kind of my philosophy overall is that I want to hold tech for the long run, and now we're at this point today. So how did it get here? Why is the stock not translating when we're seeing all this huge demonstrations on multiple occasions, beating the best models out there, and not just by a couple percentage points of higher levels of accuracy? No, it is kicking their ass by orders of magnitude. Why has the stock not reflected this? Well, there's a couple things, and this is just based on my own analysis over this time, observing the business, seeing how management has communicated, and seeing where there may be limitations and why the market hasn't caught on. As I said, number one reason why Versus' stock has not climbed is there are multiple major tech companies out there developing AI that are attracting a lot of the attention, and they're all using machine learning. They're all using similar fundamental approaches today. This generates a lot of exposure, and when you're producing a novel approach that a lot of people can't make sense of and don't necessarily know how to differentiate machine learning and the common approach that has dominated everything for the past 50 years and a novel approach, it's not going to be as sticky, at least in the near term, until you really demonstrate it, not only from these benchmarks, but as well as from a commercial standpoint, that it's much more efficient. That's number one. Now, the second one is the company had, and this has been a constant criticism, not just by me, but many investors, is management wasn't doing as much as they should when it comes to transparency. They would come out and say, oh, we're attracting these customers, we're bringing these beta testers and businesses into our system, and they're going to be trying things out, and it's going to lead to a commercial contract. And a lot of them didn't come to fruition, and there was no communication or explanation as to why that happened. It just left a lot of questions in people's minds, including myself, like, what's happening next? Why hasn't this project or this thing that was highly touted by you come to fruition? Or if it did, why haven't you provided us any additional information on its progress and development, where it's going, what you've learned from the experience, all these things that I think are really beneficial and give us a good understanding. On top of that, if something does fall through, taking accountability and just highlighting that, well, we misread this situation, or things didn't work out here for these reasons, but we're going back to the drawing board, whatever it may be. Just a level of accountability and transparency that I think investors appreciate. And, a lot of companies don't necessarily do that, but when you want to compare, I think ultimately, like, Warren Buffett is the best example of somebody with a high level of integrity and transparency. And he did a great job always of communicating even when he made a mistake. And that's, I think, a fundamentally important thing for instilling confidence that I think Versus's management at the time failed to recognize, and it just didn't give investors total confidence that things were progressing as a lot of times they made it out to seem. Now, the next part of it is that while they were developing this really impressive technology that continually beat top models, I think they cast their net a bit too wide. And as I'll highlight, or you'll notice shortly, is that I think the current management has recognized this, and they have become a lot more focused. They're primarily focused right now on building AI for finance. So they found a way that while our technology does have a capable to serve virtually every market out there, you need to demonstrate it, and you need to have a level of focus where you're improving on one thing before you can extend that net out right now. And so at the time, they were building essentially the platform and the operating system that would power all these intelligent systems for various customers and businesses. But because people aren't familiar with the technology, the approach, and everything that goes behind it, it's difficult to communicate exactly the value that can be derived from that until you demonstrate that. And so with this pivot, I actually commend the new management for that reason, because they've done a good job of being able to kind of hone in on the core asset. And if things work out here, they can easily start expanding and scaling Genius to be a platform for other developers to come in and create systems and really benefit from this more highly adaptable, less energy intensive model that exists and that they are creating. So kind of those are the three elements. And between those, it has been kind of a roller coaster ride, but it has also made it difficult to, I think, attract capital. And they've done a decent job enough, like raising from time to time, but it just hasn't instilled confidence, and the stock has been absolutely smacked. I'm down here, and it could potentially just be my own human nature and bias where I'm making the wrong decision and I'm saying I just want to hold on for the sake of it. But another part of me does still truly believe in the fundamental differences that make Genius exceptional and unique and more capable than the things that are being built at Meta, Google, Amazon, ChatGPT, or OpenAI, Claude, all of them. They have the potential to do so. And if they can really turn the corner here, then there's a great opportunity that I think this is the cheapest the stock has ever been. That said, there's also major risk that you need to understand, and it may not pan out, and it truly could become my worst investment decision to date. But I still believe That said, we should look at the financial standpoint from the company. So on top of that, what you should know is that basically in the past couple of months, it was announced that Versus CEO and founders were stepping away from the company. They have an ongoing legal situation that is kind of leading to direct conflict, and I think it was the primary driver behind them leaving the business there. So they brought in an interim CEO, and they are trying to essentially bring the business out from the depths and try and turn things around. Key figure here is their CFO, James Christodoulou, who I really appreciate. They dropped a webinar essentially explaining the current situation, and he walked through the whole financial makeup of the business today, and I think he did a good job. So between him and their interim CEO, David Scott, I think are at least recognizing where previous management and leadership may have deviated and went wrong, and they are looking to hone in on what truly makes this company unique, while also recognizing the current situation of the business. And to be fair, things are looking pretty challenging so far. When I say it, they are truly their backs against the wall, but they still have this core fundamental technology, and Professor Carl Friston remains the company's chief scientist officer. So the core's there, the belief's still there. They still have made progress and development, showcased the abilities of this asset. Now they need to find a way to generate sustainable recurring cash and capital in order to keep this thing afloat and ultimately reach a point where not only are they just surviving, but eventually thriving. But as you can see here, cash at the end of the period in terms of March 2025, they had about $4.8 million. This is down to $68,000 of cash at this time. So you should be expecting another cash raise of some sort, or taking on some form of debt, but the company needs cash to survive. You got payroll to take care of, you got assets to run, you got to be able to support that. And when you're not bringing in a profit, you got to find cash. So right now, cash is really, really low, something to keep in mind. From here, you can see that revenue in the recent year was almost $1 million in total versus just $155,000 the previous year. And from a total expense standpoint, they spent $23 million in those 9 months compared to just $24 million in the previous year. So total operating expenses are decreasing slightly, but as you can still see, relative to what the revenue they're bringing in and their expenses here, there's still quite a gap between profitability at this time, and they need cash to survive. But if they can turn the tide, and this is certainly what they're trying to do, is cut expenses. They've reduced not only their spend in things like investor relations and marketing, but they also did a series of layoffs to reduce the number of employees operating. And as James highlighted during the webinar, is that human capital is their primary major expense, but they still want to continue to try and develop Genius, try and create the product. They're still continuing to spend a lot in research and development, but there's a lot of challenges. One way or another, you can't sugarcoat it. The business financially needs to do a lot to improve its current state. And whether you think I'm crazy or not, it's a good lesson to learn that you should be recognizing these things. You should be analyzing the financial performance. There are real risks that tie to this business, but what it comes down to, and why I've always justified this investment, is they really truly are taking a fundamental different approach to AI, and it has proven to be more productive and outperform current top models. On top of that, all these major tech companies continue to invest in the same thing and think that by scaling their models and trying to refine them here and there, that they're going to reach a point where, even as Zuck has laid out, trying to achieve super intelligence. I actually think that for a lot of these major tech companies, they are going to hit a ceiling where they're just achieving diminishing returns, and they're not actually going to break and achieve the desired outcome. On the other hand, I do believe that Genius has the potential to do so, and they need to just lock in and try and make sense of it all. So, as I said, cut investor relations. And then from here, they've also cut down their overhead. So they're trying to be a lot more capital efficient, spend money more wisely. Now the next step is to try and generate sustainable cash. You can see the trend here, but if they can continue to develop the product that they're building in and grow their revenue and start bringing in cash, and turn that margin from a negative to a positive, then you're putting yourself in a good position. But even as I've said, and I've been critical of this, is these are all ifs. There is still reasonable risk that at this point, the business could dissolve into something else. Who knows? But at the end of the day, the technology is fundamentally different and it has the ability to really supersede everything out there. They just need to figure it out. And how are they going to do that? Well, that's up to the current management to try and go and make it happen and be the fiduciaries that they are for shareholders and try to do everything they can to generate attractive values for shareholders. And I've been a loyal shareholder throughout this time. I have a lot of respect for the technology that they're developing and the approach and process that they've taken. Now it's a time to tie it all together. And, at least I do got to give props, I think, between David, the interim CEO, and James, the CFO. They have a leadership now that recognizes this and is taking good accountability and is making push to increase transparency. And then on top of that, as I said, the last element is direct and hone in on one market. So with that said, they have partnered with one of the largest asset management companies in the world. They don't mention who that is, but they are developing essentially technology that can be used to help support investment analysis by looking at possible outcomes, reducing uncertainty in the market, and adapting to situations as they evolve, which, as I kind of talked about when it came to the fundamentals of large language models versus the approach that Genius is using, is that they're much more adaptable. They require a lot less historical information and kind of respond based on the current dynamics of the world. They appreciate randomness, recognize randomness, and then try and ultimately minimize that, whereas and really every machine learning system out there today takes an alternative approach. They would look at all the historical data, say, because price performed in this way, that this explains these events. Here are the correlations as to why maybe the market crashed here in 2020 and why it has jumped here. But what machine learning fails to do is it'll fail to recognize black swan events, randomness. It cannot look out into the future and really make sense of it. It is basing all its assumptions from the past, and you can run into a lot of risks. And believe me, tons of investors run into situations where they ignore the randomness, unpredictable elements of it, and they get burned. And so I commend them. I think because this is their primary customer, this is where their revenue is coming in, this is where they should focus. You're seeing demonstrations, and I think there's some great videos of Professor Friston talking online through versus his YouTube channel, where he explains basically that this is how their approach exists. They're trying to make world models for the market and try and make sense of it all. And if I do have one piece of advice for them, is that I think you can look at things on a very high level macro standpoint. You can also do portfolio rebalancing in a short term way, but many of the best investors put a lot less emphasis on the macro side of things. And if they can hone in and look at individual assets, kind of like how I'm analyzing today, and conceptually make sense of these businesses and what makes them fundamentally attractive versus others, it actually supports and coincides with trying to reduce uncertainty. Because at the end of the day, that's essentially what I'm trying to do here. And that's what every investor should be trying to, is say, there are all these infinite number of variables that affect assets price. What can I do to assure a higher level of certainty that I'm going to generate a return without taking on unnecessary risk? And the best way to do that, I truly believe, is to look at the fundamental elements that dictate a business and the value or the price at which you pay, and then look at it on a long-term basis. A month isn't sufficient, even a year is not sufficient. How do you find an asset that you can invest for 10 years and have a high degree of confidence that you're going to generate a market-beating return, or something at least that produces a return that is attractive and a worthwhile investment? That's what it all comes down to. This is a long video. It covers a lot of different aspects when it comes to AI. We looked at Meta, where it currently stands, why it has been my most productive investment so far. We looked at Versus, one of the companies that, I truly fundamentally believe in their technology. They have just struggled to prove and make it come to fruition within the market so far. there's reasonable risk that exists with this business. And, after this video, maybe you're looking at me and saying, holy, this guy's nuts. Like, why would he ever make this investment? Or why wouldn't he walk away when he should have? Could be true. But I'm willing to take this bet. I'm still young, and I think that gives me a certain level of willingness to take risks at this time because, at the end of the day, I don't want to come back 20, 30 years from now and say that I was spooked out of taking chances on core beliefs of mine when it comes to technology like this that could be game changing and transcend everything else. So with that, talked about a lot of things. Hopefully I didn't ramble too much and I provided some useful information on 2 companies that I still currently own and have continued to hold since 2022. And once again, if you find the content useful, make sure to like, subscribe, and comment as it really helps the channel grow. And I appreciate it all. Thank you very much.